For much of the last decade, equity crowdfunding under Regulation Crowdfunding, Reg CF, has been regarded with skepticism in traditional capital markets. Critics argue that crowdfunding was a last resort for companies unable to secure institutional backing, home to underperformers, overstatements, and inflated hopes. In short, they saw it as a marketplace for lemons. But new comprehensive data from Crowdfund Capital Advisors, CCA, which tracks every SEC-compliant Reg CF offering through its CCLER dataset, paints a very different picture. The evidence suggests that the crowdfunding landscape has matured dramatically, and the argument of adverse selection no longer hold. Myth number 1. Only desperate startups turn to crowdfunding. Reality. The profile of companies using crowdfunding has fundamentally changed, and the financials prove it. When regulation crowdfunding launched in 2016, 62% of issuers were pre-revenue, and 73% were less than 3 years old. In short, the market was dominated by early-stage, high-risk ventures, many of which had unproven ideas and minimal operating history. Today, the landscape looks very different. As of 2025, 64% of Reg CF issuers are now post-revenue, and only 46% are considered startups under 3 years old. The shift isn't just qualitative, it's quantifiable. In 2016, the median revenue for issuers was effectively zero, and average revenue stood at just $277,000. By 2025, those figures have surged to $439,741 median and nearly $2.7 million average. Keep in mind this includes debt issuers who historically are smaller cash-flowing enterprises. These are not fly-by-night ventures or idea-stage prototypes. Today's issuers are often operating businesses with substantial revenue, market traction, and growth plans. Additionally, 22.9% of offerings in 2025 are follow-on rounds, meaning companies are turning to Reg CF for additional capital, not as a last resort, but as part of a repeatable capital strategy. These issuers are leveraging crowdfunding not just to raise funds, but to activate their customer base, build brand equity, and drive sales. This evolution in issuer maturity reflects a broader trend. Investment crowdfunding has become a viable channel for established companies to scale with community support. The myth of desperation has been decisively replaced by a reality of growth stage engagement. Myth number 2, crowdfunded startups fail more often. Reality. Crowdfunded businesses are more resilient than the national average. According to the Bureau of Labor Statistics, roughly 50% of all U.S. businesses fail within 5 years. Yet, CCLER's longitudinal analysis shows that only 25.5% of crowdfunded companies have gone out of business, even after several years of market exposure. This is a significant finding that underscores the viability and strength of investment crowdfunding as a funding mechanism, notes Sherwood Neese, principal at Crowdfund Capital Advisors. This performance comes despite the fact that many of these firms began without traditional institutional capital or venture backing. In fact, crowdfunding has emerged as a proving ground for companies that subsequently go on to attract follow-on investment. Myth: issuers can easily misrepresent their quality. Reality: crowdfunding campaigns operate in a highly transparent and increasingly rigorous environment, both from a regulatory and reputational standpoint. Unlike informal fundraising or private placements, Reg CF offerings must be filed with the Securities and Exchange Commission SEC via Form C, which includes detailed disclosures on the business model, financials, use of funds, risks, and ownership structure. These filings are publicly accessible and legally binding, but regulatory disclosure is just the beginning. The offering pages themselves have become battlegrounds for credibility. Prospective investors, many of whom are industry insiders, engineers, analysts, or former founders, routinely scrutinize the viability of the idea, intellectual property claims, total addressable market TAM, and especially valuation. These campaigns are not private conversations behind closed doors. They are real-time negotiations with thousands of stakeholders, often played out in public comment sections, Discord channels, and live Ask Me Anything AMAs. Entrepreneurs who cannot defend their assumptions quickly lose the confidence of the crowd, and with that, their raise. It's not uncommon to see campaigns stall or collapse if the founders fail to justify their projections, or if red flags are surfaced during the vetting process. This interactive, transparent vetting process doesn't just weed out weak campaigns. It reinforces trust in successful ones. When entrepreneurs are able to stand behind their disclosures with clear, defensible logic, they often emerge with stronger cap table, higher investor loyalty, and a community of engaged supporters. In short, transparency isn't just a requirement, it's a competitive advantage. And that reality sharply undercuts the idea that adverse selection or low-quality signaling is endemic to Reg CF. Myth number 3. Top startups avoid the space. Reality. Crowdfunding is no longer a sideline activity. It's becoming a strategic tool used by leading startups and embraced by venture capital. In just the past month, nearly 30% of Reg CF offerings include a venture or institutional investor on the issuer's cap table. That's not a fluke. It's a signal that traditional investors are rethinking their stance on crowdfunding. What was once considered a cap table complication is increasingly viewed as a strategic advantage. Venture capitalists now understand that having hundreds or even thousands of retail investors, many of whom are customers or subject matter advocates, can strengthen a company's market position, deepen loyalty, and drive sales. These crowdfunders aren't passive shareholders. They're engaged stakeholders, grassroots marketers, and sometimes even product evangelists. This is particularly powerful in consumer-facing or B2B segments, where early traction and brand trust are essential. Founders are using crowdfunding to build momentum and prove market fit in parallel with institutional capital, rather than in conflict with it. The result is a collaborative financing model where VCs benefit from broad-based community validation, and retail investors gain exposure to deals that previously would have been out of reach. And if venture firms are as skilled at diligence and identifying winners as they claim to be, then the crowd co-investing alongside them is not a sign of weakness. It's a positive signal of alignment. Crowdfunding is not a last stop. Increasingly, it's part of the go-to-market strategy for top startups, and a growing number of institutional investors are along for the ride. Myth number 4. Crowdfunding is too opaque to be taken seriously. Reality. The best-informed players in private capital already rely on crowdfunding data. They just don't always admit it. For years, one of the perceived drawbacks of the crowdfunding market was a lack of visibility, fragmented disclosures, inconsistent reporting, and no centralized data source. That narrative is now outdated. The CCLER dataset, maintained by Crowdfund Capital Advisors, is the only 100% complete, structured, and daily updated source of regulation crowdfunding data in the United States. It captures over 10,000 SEC-compliant offerings by more than 8,400 companies, totaling nearly $3 billion in capital commitments, with over 5 million structured data points spanning investor behavior, valuations, financials, and compliance. This data isn't just useful, it's becoming essential. Venture firms, asset managers, family offices, and hedge funds are increasingly consuming CCLER insights, whether through direct data access, internal dashboards, or regular engagement with published research and market reports. If capital is increasingly flowing into early-stage private markets, then understanding those markets is no longer optional. The simple truth is, in any market, the best data wins. And in the world of online capital formation, there's only one comprehensive source. Whether you're deploying capital, evaluating trends, or identifying breakout sectors, the ability to benchmark and forecast using CCLER's proprietary dataset is a clear advantage. The rise of the investomer. At the core of this transition is the concept of the investomer, a customer who becomes an investor. Unlike traditional capital sources, investomers bring both capital and conviction. They evangelize brands, offer feedback, and drive organic growth. For many companies, this dual-role stakeholder is far more valuable than an arm's-length VC. Investment crowdfunding is no longer a novelty or fringe financing option. It is becoming a mainstream capital strategy with a fundamentally different and increasingly powerful economic logic. As the data mounts, one thing is clear. The adverse selection argument no longer matches the reality of who's raising capital and who's succeeding in the crowdfunding economy.